In today's video, I am going to be breaking down Kevin O'Leary and his European dividend stocks that he holds. So let's get down and let's check this out. So we're going to base this off of OEUR, which is an ETF that Kevin O'Leary holds and actually runs himself. The other thing about O'Shares Europe Quality Dividend ETF is the fact that Kevin O'Leary will only invest in O'Shares ETFs for companies that are on the stock market. He does invest in, obviously, other companies when it comes to his Shark Tank and other angel investor type of investments. However, when it comes to the stock market, he only holds these ETFs. So as the ETF itself, it does have a 2.8% yield. It does have some pretty low volume at 6,000 shares traded per day, and its expense ratio is 0.48%. I wonder if Kevin O'Leary actually pays that. That's going to be very interesting, and if anyone actually investigates that. Over a 5-year chart, you're going to see it's traded pretty much sideways, of course, until recently. And then, of course, since the whole recovery since the virus, of course, we have had some really great times market-wide. So his top holding in that ETF, and obviously for himself, is Rosh Holdings. This has a 2.5% dividend if you were to buy it yourself outside of the ETF. And it does have some pretty good volume when it comes to 1.1 million shares traded per day. Its 5-year chart's interesting. It's also had a consolidation period at the beginning. However, recently, from 2019 to 2020, it has gone up in value. It really never dipped all that much when the virus hit. That's not a massive loss. And then since then, it has recovered and then gone down once again since recovering again, hitting roughly the same mark as it was at after the initial recovery phase. It's going to be interesting if it can break out past that point. We can also see that they raised their dividends substantially over the ages. So we can see from way back in 2014, it was $1.65 a share, now being $9 a share per year because it is a once per year dividend. Something that is quite interesting is revenue-wise, they were doing really well, same as earnings. However, 2020, just like many companies, they did have a little bit of pullback in the revenue. However, their earnings were better than the previous year. So that actually tells me two things. That tells me that they were able to cut back on staff and maybe cut back on maybe office space or whatever it may be, but they were able to make cutbacks because they were bringing in less revenue, which then, because they probably made the same amount of money, technically speaking, when it comes to earnable income, then when it comes to their earnings, because they made those cutbacks, they were able to actually end up at the end of the day to make more money, which then tells me as an investor that if they can continue along with having those cutbacks and still able to grow their revenue with lesser expenses, then their earnings are going to become even better and their dividends should become even larger. Next is a company that everyone loves, Nestle. Nestle is, of course, a chocolate company. They also sell water and many other things. From there, it has a 2.5% dividend and 3.2 million shares traded on average every single day. So that should allow you to get in and out of it quite easily. Nestle's ticker symbol is NESN, and we have seen very similar chart as the last one we looked at, some consolidation, and then of course, nice, huge run-up going into the middle of 2019. And then obviously in 2020 we had that crisis, in which case it has recovered and of course leveled off. It did dip one more time, which this gives you two buying opportunities, and for some people this may be classified as a double bottom, which means that there should be some good momentum coming very soon. Next, we'll look at their dividend, and we can also see that they only pay a dividend once per year. And it has been increasing to a good amount. The only thing is that it's just not increasing the same as Roche, which would have been nice and interesting. However, when you're looking back, let's say 10 years, $1.85 a year in dividend to now being a $2.75 dividend in 10 years, that's not a massive increase. It's not even double, but it is a substantial dividend increase nonetheless. They tend to have stagnating revenue. Of course, we're not going to count 2020. However, they do have increasing earnings. And even with the decreased revenue, they still did really well with earnings anyways. Novo Nordisk is another great company from Europe that Kevin O'Leary invests in. This one is a 1.4% dividend, so not a huge dividend, and the average volume is 1.8 million shares traded every single day, so it's not massive by any means. However, you're not going to be probably trading 1 million shares a day anyways at $638 a share, so I wouldn't really necessarily worry about volume at all. We can also see that this has a nice slow increase, of course, until recently. And this tells us that this is a nice solid company to invest in. There's not really huge, massive fluctuations until here. But when we're really talking about it, we're not seeing any massive changes like this. So at this point in time, we can really kind of gauge where we want to buy in. Every couple of months, there's a little bit of a pullback. Now, this has kind of got me curious. Will this be sustainable? Will it pop back down and go back into its trend, or will it continue the previous trend as before? It's going to be quite interesting to see what happens. Now, this is an interesting stock because it'll pay a dividend 2 or 3 times a year. We've seen, of course, sometimes twice a year. Other times we see 3 times in a year. Then it goes back to 2 times. So it's going to be quite interesting. Of course, sometimes it's one time per year. But either way, it seems like they are increasing their dividend every single year anyways. It's also nice to see revenue increasing, and of course I would like to see earnings increasing more because of course there's higher revenue, but at the same time, anytime that you are increasing your revenue every single year, especially when you have a year like 2020, of course you want to see what they're doing, what type of investments that they're doing, whether it be R&D or purchasing companies, because revenue is king. You always want to have more revenue. Believe me, if you have lots of revenue, even if you don't have a lot of earnings, you can eventually turn that switch on if you have high enough revenues. Now, the reason why they had a great 2020 is because they are a healthcare company, and of course, pretty much any healthcare company has been needed over the past year and a half. Another holding of Kevin O'Leary's is Asml Holdings. This one pays a very small dividend of 0.4% and has 700,000 shares traded per day at $789 per share. Quarterly, it's had 1 miss, and of course the last 3 have been beats, which is great. Revenue is what I'm really excited about. Check out that amazing revenue stream. Increases every single year, including 2020, and earnings have been going up as well. Now, the reason why this one's been going up is because they are a semiconductor type company. They are a tech company. And anytime you have a shortage of semiconductors, you are going to be seeing the prices of those stocks go up. And right now there is a worldwide shortage on those. We can also see in the past a nice steady incline in their stock price. Until recently, since the crisis, we have seen an explosion to the upside, mainly because of that semiconductor shortage. They can sell their processors for more money, which means that they are making more money. And the last one that he holds is this massively named company, Hennessy, Louis Vuitton. We all know those names, $706 per share. This one does pay a 0.8% dividend, and its volume is not bad, considering that it's a $700 stock. Now, it's no big surprise that 2020 was going to be a hard year for them, mainly because you're looking at a company that is in that segment of the market that is more for the billionaires and rich people. Louis Vuitton is, of course, one of those luxury brands, and of course, whenever there's a recession or that kind of a feel, those luxury brands are usually going to go down in cost. And we can see that there was an increase before all of this. They were not increasing their earnings all that much, but their revenue was increasing. And remember what I always say, revenue is king. And of course, 2020, they did go down, but they were still making a good amount of money. And of course, they have a nice increase. Recently, it's been a bit higher of an increase in stock price. which is always good to see. We did see, of course, a little bit of a downturn with high volume. Anytime that happens, it's usually going to mean that there's going to be a big run coming up. Anytime that there's a big, large portion of investors leaving the marketplace, which we did see, there's going to be a lot of buying in afterwards. Because, of course, the stock market is like a drug to some people. Once they're out of it, they have cash that's making them nothing, and then they have to invest anyways. So what are they going to invest in? They're going to be investing in companies. Sometimes the reason why you'll see this is because the funds will have sell warnings, and it's all electronic. And that's why sometimes just having a level head and not selling when there's massively bad news is sometimes a good reason to then, or a good way to invest, because then you can just invest more afterwards. Anyways, I hope that you've enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again next time.